Hey everybody, I'm here with you on a stock market crash update. Wild week in the stock market. There's a lot of talk about it, at the very least, a temporary stock market bottom. That the selling has been overdone, we're oversold, and that we're looking to get that dead cat rally or even possibly a new trend line starting with the week ahead. How much of that can we trust? I mean, less than a month of selling. Or are we really saying that, man, this is way overdone? We can't foresee this market going down any further. We're overreacting to the Fed raising rates in March? No, I don't think so. In fact, if anything, we might not be taking this sell-off serious enough. There's this consistent need to buy the dip. You're seeing very little panic selling. Instead, it's been more of a sell-off of like 1,000 cuts, just trickling lower each and every day. And then you get these 200-point rippers off the lows and everybody feels better again. And they start buying it, thinking that they're going to miss out on the next big rally because they've been trained to do that. They've been trained to think that, hey, every dip is buyable. It's just some dips are bigger than others. But let's take a look at the year as a whole so far. The S&P 500 is down 6.6%. You have the NASDAQ 100 down 11.5%. You have the NASDAQ Composite Index down 12%. And then you have the Russell 2000, the weakest of them all, down 12.2%. Is that really a market crash? No, it's more like a market correction. And you can't even really say that as much about the S&P 500 because right now it's really only just down 6.6%. In fact, from a week-to-week basis, the NASDAQ 100 is only down 2 out of the last 5 weeks. That's incredible. The S&P 500 is down 3 out of 5. The Russell 2000 is down 4 straight weeks. And you got the composite that's diverging away from the NASDAQ 100, mainly because the FANG stocks have held up so well, minus Netflix, during all this selling, that the composite's feeling much more the impact from all the other stocks that are in its index. It's down 3 out of the last 5 weeks. People are freaked out about the selling. A lot of people ignored the fact that there was this bearish divergence that was going on all year in 2021, where stocks like SQ and PayPal and Datadog and Roblox were just getting hammered and seeing massive amounts of losses off of their highs. People were like, oh, that's not a big deal. Now that we've got the selling, everybody's like, well, this sell-off has been going on forever now. We should just look at all the other stocks besides the FANG stocks. They've been getting hammered forever. It's not like the sell-off just started. So they're trying to have it, their cake and eat it too. They were ignoring it when the market was going up, and now they're paying attention to it when the market's going down, using it as an excuse for why the market should be bottoming. You can't have it both ways. Yes, most stocks besides the FANG stocks have been going down for a long time, but when you get those FANG stocks to actually start selling, what do you think it's going to do to all the other stocks in the market? It's going to create panic, and people are going to bail out of everything. They're going to get margin called on their FANG stocks. They're going to have to sell their other positions as well. That's much of the reason why you're seeing so much weakness in Bitcoin, why Bitcoin keeps going down with the market, is because when people are getting margin called in equities, they're having to sell out of even profitable positions to get out of those so that they can raise the capital to meet the margin call. And to think that this market can't sell off more than just 1 month is foolhardy, guys. You don't have to go any further back than just even the COVID 2020 sell-off. That was 3 months. You go back to 2018, that was another 3-month sell-off. But if you go back to like 2011, you're talking about 5 months of selling. Go back to 2008, and then you have about 1.5 years of selling. And then the dot-com bubble, you had 2 years of selling. What has happened over that time since 2000 is that the sell-offs have getting smaller and smaller because the Fed intervention has been getting bigger and bigger and bigger. We have a $9 trillion balance sheet with the Fed right now, and they're going to start selling some of those assets. We got the rates getting raised in March. They're going to have finished tapering in March as well. All these little stimulus programs that the Fed has been giving to the stock market is going away. So there's the headline risk. You also have the risk with war in Ukraine. And unless there's something brewing under the surface that's a positive effect on the market that we don't know about right now, there's not much reason to believe that the stocks are going to just march right back up to all-time highs from here and establish new ones, keep the rally going from 2021. We're so caught up on this being one of the worst January sell-offs of all time. We need to be looking at the overall extent of the sell-off. Yes, we could end up rallying into February just like we rallied in November of 2018 during that 3-month sell-off. Would not be surprised at all, because to think that, okay, we're going to just drop 6.6% every single month in the S&P 500 and 11% in the NASDAQ 100 each month, no, that's not going to happen. Even 2008 and 2000, you had periods where the market managed to rally. And so we should expect that, and we can even play those rallies. But we should be taking profits aggressively during those rallies and expect at any time for the market to actually sell back off again. So many traders, especially those over the last 2 years, and even more so over the last 11, 12 years since the Great Recession, has this sense of entitlement to nonstop rallies and to never having a correction. And that just is not going to always be the case. There will be another major pullback in the market, whether we're in one right now or in one down the road. It's going to happen. And you always have to prepare yourself by managing the risk, by never thinking that the market will simply just forgive you for when you don't follow your stop losses or trading plan. Now, I'll get a lot of comments from people that'll say, hey, Ryan, the PE ratios were astronomical during 2000. Ryan, the banks were blowing up in 2008. This has nothing to do with 2000 or 2008. It's nothing like that. But guys, every sell-off is not like the previous sell-off. There's always a different catalyst that causes the sell-offs. And in this case, we have an everything bubble that the Fed has endlessly promoted and propped up for the last 12 years. And now that they're starting to take away and move their hand away from the market because we're getting inflation, it creates a lot of problems for this market going forward. And while I'm not trying to scare you into selling everything, you should be respecting the market and what it can do. You've gotten a preview of it this past few weeks. Respect the markets and the chaos that it can create for your portfolio. But enough about what I have to say. Let's look at the S&P 500. We're going to go through the three main charts: SPY ETF, we're going to go through the QQQ ETF and the IWM ETF, and we're going to go through all the technical analysis for each. Let's get started on that right now. First up, we have the S&P 500, stock symbol SPY. Incredible rally off the March 2020 lows. It seemed like it was the forever rally that would never break until the month of January here. Some good technical developments coming out this week with SPY holding its October lows. Yes, we dipped down below it on Monday. It looked like things were going to get really ugly this past Monday. Then you had a 200-point ripper off of the lows. And while we sold off Tuesday, Wednesday, and Thursday, we were able to book in Monday's profits with another rally on Friday in the final hour and a half of trading. This is big, but the only problem here is when you zoom in, you have resistance at the 200-day moving average, testing it 5 days in a row, unable to break it. So you have the October lows that it's trying to hold right here. And then you have the 200-day moving average, this white line that it's unable to break through just yet. So how the market opens on Monday and how it continues from there. Can it hold the gains above the 200-day moving average? If it gets a gap up, will be important. If we see a gap down, how is it going to respond to the retest of this October lows? Can it hold it just like what we have seen all of last week? I think you can play this bounce, but we need to get back up above that 200-day moving average. And like I said earlier in this video, you don't want to trust your profits. You don't want to trust these positions just to go straight back up to the all-time highs. If they do that, that's nice, but take some profits along the way to make sure you're managing the risk in case this market does fall back apart. Another area, if this rally can continue into next week, watch this 450 level right here on SPY. If we continue to get this rally and it tests this 450 level, this is where everything started to break down. If it hits this 450 level and you see a sharp price rejection, that's a place where I'm looking to get short. If it can't get up there and it sees the rejection at the 200-day moving average instead, you can either play that rejection of price knowing that it has support nearby that you may have to cover pretty quickly, or you wait for support to break and you get short from there. Now, the best case scenario is for it to rally and fail at this price resistance here. That way you can play it to the long side and then play it to the short side when it gets rejected. Dead cat market bounces tend to last a few days. The second day is usually the one that it struggles with most, but if it can get past that without giving up too much of its gains or even build upon the gains on the second day, usually that third or fourth day can make some really nice profits for you. So be on the lookout for the bounce, but also be ready for some of these resistance levels that loom large ahead, particularly this 450 level, and whether or not it can break through it. If it can't break through it, that's going to be a signal for me to get short again. Now on to the Qs. Unlike the SPY, this thing has struggled with the October lows quite a bit, but it's finishing just above it. If I zoom in just enough, you can see where price snuck just above those October lows. So we got a good development there. However, one thing you want to be careful of is this declining resistance level off from the January highs. This level needs to break for you to have any confidence in a sustained bounce to the upside. Yes, the bounce that we saw on Monday, that was nice. That was really good. But it also showed you that it was no guarantee for continued follow through to the upside. And so while this bounce on Friday, especially in the last hour and a half, was really good and really exciting for a lot of traders, and it helped give them a little bit of relief from the selling that we saw Tuesday through Thursday, it's not a guarantee that we're just going to march right back up. So if we can break this declining trend line, then you're going to want to watch this resistance level here. This is what marked the top on the Qs. If it gets back up to this price level resistance, you're going to want to see, can it break through it? If it can't break through it, that's going to be my signal to go ahead and get short again. On the flip side, if this is all that we're going to get to the upside, was the rally that we saw on Friday, then I'm going to wait to see, okay, are we going to break below the Friday lows? And if it does, then that's going to be my other cue to get short on the NASDAQ 100. On IWM, the worst looking index from a technical standpoint by far. Massive, massive support broken on the chart. Does not look good at all. This channel that we were trading in for almost all of 2021 completely broke down here in 2022. There is, though, because of this, the straight down nature that we have seen out of IWM, there is the potential here for it to stage a big rally. And if it does, maybe this 212 resistance is where it wants to go before it goes back down again. If it fails at this resistance here, that's my cue to get short on IWM. But it could also break through this resistance I just outlined to you at 213 and tested this declining trend line at 217. Hits that declining trend line at 217, that's going to be another place that I'm going to mark as a potential area to get short on the market. Now, there's not a lot of support on IWM on the downside either. In fact, this chart really scares me. And the fact that it doesn't have any of the FANG stocks, which has held up a lot of the other indices, gives me a lot of pause going forward, because you have this massive support level that goes all the way back to 2018. You can see it hasn't been tested in a couple of years, but it offers tons of support. And it seems like right now the most logical place for the Russell 2000 to eventually test. So I'm looking for IWM at some point this year to get back down into this 170, 165 level before it really has a chance at putting in a legitimate bottom in this market. So what's the takeaways here, guys? Again, and I say this in every video, be diligent with your stop losses. Make sure you're planning out your trades. 2, trade lighter. And when I say lighter, you don't have to have 100 positions. If the market bounces and continues to build off of the rally that we saw Friday afternoon, that doesn't necessarily mean you need to go 100% long on the stocks. Instead, go with like 1 or 2 positions. If you're wrong, it will not hurt that much. And if you're right, you're adding profits to your portfolio. One of the things that has saved me the most in this market and has allowed me to be profitable this month is the fact that I haven't taken on a large number of positions. I've been keeping it very manageable, very easy for me to get in and out of my trades, while actually making profits on both sides, on both the rallies and on the sell-off. So one of the things that I think is going to work really well in this market is not putting in 100% of your profit on one single trade. It will keep you in the game and allow you to navigate some of the most difficult markets that you can possibly trade through. If you enjoyed this video, make sure to like and subscribe. And just like I said in the beginning, make sure to check out the YouTube membership by clicking the join button down below, and you'll get all of my market research that I provide each and every day. That's going to include my watch list, the stocks that I'm looking at trading, plus updates on the FANG stocks, the market indices, and more. Check it out. Let me know down in the comments, how are you holding up in this market? Yes, we've seen a lot of selling so far this month, but how are you doing? Let me know. I would love to discuss it with you guys in the comments. Thank you guys, and God bless.